Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure. I'm your host, co-host, Guy Allard. How you doing, Guy?
That would be me.
Good. Oh my gosh, what did we do last week? Oh, I think we got swamped and had to do because one of our shows was messed up at SoundCloud. I apologize for that. They all work now. For those of you new to the show, we developed this show to answer your financial questions. We try to do it in a plain spoken language that you can actually understand. So many advisors try to give you all the Greek letters when they're trying to explain a mutual fund, and nobody knows what they're talking about.
Now, I don't know. Now, the guy that just introduced us said we were plain-spoken truth and hard-hitting.
Right. Yeah, we got to be hard-hitting, right? Well, there's everybody that's not living under a rock right now knows the Republicans are trying to do some tax bills. They're trying to reduce taxes. Part of that reduction in taxes is getting revenue from other things or changing other things. First, we haven't got the full thing on the Senate bill. I have to still research that. It came out like last Thursday or yesterday.
They were talking about that Thursday morning, and Stuart Varney had Art Laffer, one of the architects for Reagan's plan, and reminded me of a fact that I thought was pretty interesting. You and I talked about it earlier in the week. And they were talking about once the Senate got this bill, one of the things they did was they were going to phase in the corporate tax reduction. They're all trying to, originally was 15, and now it looks like at this point, maybe they'll get it down to as low as 20. And Stewart was asking Art Laffer if he thought it was more Reagan-esque now because of the phase-in. Reagan, if you remember, phased in the income tax
Personal income tax. Yeah.
Yep.
He didn't do corporate, right?
That's correct. And Laffer about came out of his seat, and he said, absolutely not. He goes, that was the worst thing they did. He goes, what do you do if you know taxes are going to be cheaper next year? You put off income, you put off production, you put off everything until you can get into the lower rate. You and I have talked to clients about that. So we don't know if there's going to be death tax anymore, and let's wait till January. Let's find out, right? We can make better plans when we know what's going to happen. Right. And Laffer went on. He referred it to the Great Recession of 81 and 82 because they phased this in. Once you know rates are going to be cheaper later, you put your production off, you put your sales off, you put your income off, and he said it immediately. He said it was the worst thing they did, and if they could have anything back, that was the deal.
It was a big recession, 81, 82, I believe, from it, right?
That's absolutely.
I'm a big proponent of, obviously, since I own a small pass-through business, of lowering that 39.5%. It's actually 39.6 plus extra Medicare if you make over
plus, right? Like, at least we get out of the Obama plus.
You get an extra 0.9 for Medicare, even though you don't get the Medicare Gold plan or anything when you retire. It's the same one. And that does hinder small businesses. I don't care what anybody says.
Absolutely.
When 40% comes off the top to build your business, that's a lot. That is easily the highest tax bracket on the planet.
And what do large businesses do? They keep their money offshore. They don't bring it back because of that.
And plus, the large businesses have all these, I don't want to say scams. They're write-offs and carry forwards and everything else. It's amazing. I pay 39.6 taxes for my little corporation, right? But a giant company might pay none, 6%.
And that reminds me of carried interest, but I guess that's another.
And that's what they're talking about doing too, is lowering the tax bracket, but getting rid of the loopholes.
That's right.
And so those companies will go back to paying 20. So it'd be bad for them, is what they're going to think.
And on that, in line with that, as far as getting rid of the loopholes, Laffer went on to say, and again, he was about out of his seat. He was loud. He was forceful. He said, if you're going to do it, just do it. Don't phase it in. But I love the second line. Of course, we live in Texas, so it's easier. It's a little bit, we're subjective here, not objective like we are normally. But he said, I'm tired of New York and California and all of these places that have high state taxes because of their state expenditures getting a free ride on us. We have, Texas, we're no saint here. We still have to pay taxes. It's just dovetailed into other things, right? It's into your school tax, into your property tax, your sales tax on what you buy. I mean, we still have those taxes, but these large states get to write it off, and we don't. So
it's amazing. I heard it was a senator from New York, I believe, or the governor of New York, I can't remember.
Yeah.
Saying that, no, that's all a bunch of BS. We are net positive to the government. I'm like, shouldn't everybody be net positive to the government? Don't we all have the, government services
I heard
for our
that
states?
same argument.
But all it is we're net positive. I go, Mississippi's 10 times more net positive than you, and they got a lot less money. That doesn't, just because you're net positive doesn't mean anything. I go, everybody should be positive because every state should have to pay into the collective to be able to live in the country for the military and all that.
And net positive is, just for those people that don't understand?
More is going into the government that they're taking than they're writing off.
They're taking, that's right.
Just like we don't write off anything here, right? So obviously all of it's going to the government, except we do write off sales tax.
That's
so if
true.
you're a huge spender like Guy and I, that does make a little bit of difference anyway, right?
There it is.
I guarantee. I looked at when I bought a house or a boat. I'm like, look at that tax. I mean, the sales tax. Oh my gosh. All right. Excuse me.
Do you think we solved the tax problem?
Sure.
Then we can move on.
Right.
As long as that's solved, we can move on. I didn't want to move on unless we had the taxes solved.
Here's what they're proposing for retirement savings. This is a show about finance and your personal savings. So we're going to show what it does. Okay. For any of you out there have taken 401k loans, okay? The proposed legislation, normally, let's say you leave the company or the plan terminates, you have 60 days to pay the thing back. What happens if you don't pay it back, Guy?
You get taxed, and you have a penalty if you're under 59 and a half.
That's right. Tax bill comes. So if you took $100,000 out of a 401k, and they, like I said, you terminated service, they terminated you, you terminated them, whatever.
You have $100,000 in income now.
That's right. So you had 60 days to pay that back. If you don't have that money, obviously it's $100,000 income. And think about that, what that does to your tax bracket. If you're making 100 now, you're making 200. Whatever the number is. And so,
and a 10% penalty.
Right.
It's another 10,000.
All they're doing, they're saying, well, they're going to extend that. Instead of 60 days, we're going to give you have to normally file taxes, not with extensions and all that. So it'd be April of the year after. So if you terminated like early, like say in January of 2018, you would have until April of 2019 to pay that money back without the taxes.
Interesting.
So that's one thing. The other one is one of their proposals, hardship distributions. Okay? It'd make big changes to hardship distributions. All right. It allows, right now, if you take a hardship out of a 401k, 403b, whatever, right?
And that's a pretty broad category.
If you take a hardship out of it, under current rules, you cannot contribute to a 401k for 6 months. For 6 months, you cannot contribute to anything to the 401k because you took a hardship out. All right? Now you can, and also it can only come out of your contributions, not the employer contributions. Well, the proposal is it can come out of either one. Okay? Some people don't like that because if it comes out of it's going to wreck people's retirement because they're going to take too much out of their 401ks, blah, blah, blah. Another proposal. So, the first one is
they're all about getting. Excuse me for interrupt. They're all about getting their taxes now, not about our retirements. I'm seeing a trend here.
What they're doing is they lower something so they get some stuff.
Yeah,
back,
they get the money now, and that's kind of like. And I don't know that it made the list. Hopefully, I'm not preempting you here, but they had talked about coming up with more plans similar to the Roth, where they could get all the tax now and defer. Not getting the taxes later, like in a 401k. I don't know that they implemented that.
Well, a lot of stuff, like extending the time you can pay back a loan, that's decent, because 60 days is a pretty quick time.
I agree.
A hardship allows you to take out more hardships, plus you can still contribute, again, instead of stopping your contribution for 6 months. I think that'll help you. Another one's in-service distributions. Remember, anybody with a 401k can take out any and all the money they want and put it into an IRA or whatever once they're 59.
And they don't have to end the plan and quit contributing.
That's right. You're still going to work the company 10 more years, whatever.
Yep.
Doesn't affect anything, but you can take the corpus out and do something, make it safer if you don't have any good
if you're
choices in your
59 and a half or
right.
above. That's right.
But state and local governments like your 457 plan, stuff like that, they can't take it to 62. Okay? So the part of this legislation is allowing them, bringing them in line with 401ks.
Level the playing field.
That's right. So people, when you work for the state, local governments, you're already aware of this. You can't take out till you're 62. Now it's going to try to go back to 59 and a half, which makes sense. I don't know why a government employee would have a difference than a private employee when they could access their retirement savings, right?
It's because the government manages things so well.
That's right. The government always does everything well, and so cheaply, right? All right. There's another thing they're proposing. You cannot recharacterize a Roth conversion. I know it's weird. Right now, you can do Roth conversion, right?
Right.
Take any IRA and turn it into a Roth.
How would you once it's a Roth, how would you recharacterize
You can recharacterize it as an IRA.
Oh.
But you won't be able to if they get the you won't be able to undo a Roth conversion. It's usually a planning strategy. They didn't plan it correctly. Now they're going to be the 39% tax bracket doing it this year. If they could have phased it over a couple years
So if
ago.
they go back to an IRA, do they get their taxes back they paid to make it a Roth?
Yes.
With interest?
Yes, they could before. Now they won't be able to.
Nice.
All right. Not with interest.
Oh,
No.
Well, there
Right.
it is.
There's another thing. Your pre-tax limits, the one thing they got a lot of pushback on is they were trying to reduce the amount you can defer from your check in your 401k. They were going to say, all right, we're going to let you take out $2,000, and right now it's what, $18,000 you can take out?
$2,000 a month if you're
Yeah, it's that's right.
over
$24,000 if you're over 50.
Yeah.
They're going to make it like $2,000.
for the year.
That's right.
Right.
And the rest can come out of your after-tax money.
Like a Roth.
So you'd
sort
have
of
like
plan.
it didn't even say it was going to be tax-free. It's going to go, it's tax-deferred, right?
Right.
But you're going to have one pile that's going to be tax-deferred. The principal has been taxed. The other one that's not. And so everything would be kind of a dual thing. They're calling it the Rothification of 401ks. They said no, but they haven't changed that. So they decided not to do that in the House's bill. Who knows what the heck the Senate's bill is going to be, because they can't stand each other apparently because they don't listen at all. They come up with their exact different plan. They all hate each other's plan. Nothing gets done.
It's completely different.
That's right.
Why does it even go through the House, you wonder?
All right. Let's see. Oh,
Hey,
talking about the pass-through rate down to 25%. Remember we talked about 20? The rub on lowering the pass-through rate from 39.6 to 25, even though they wanted to be 20 originally,
Right.
which I'm in favor of, is they thought that since company owners, small business owners, can pay a 25% tax bracket, why would they put money in a 401k that eventually they're going to pay 39% on when they could pay 25 and be done now? Okay, which that's a legitimate thing, but I don't see it as much of an issue because 401k plans, they keep people, they keep employers, keep employees happy, all that kind of stuff. Plus, it helps them. So it's still a write-off to the business, and so I don't see it as much, but I guess it could affect it a little bit. People was asking, why do you care about that 39, these big companies? Well, I think it's 75-80% of America is employed by small businesses.
Yep.
It's not your giant companies. You would think those companies with 100,000 people, that has to be a huge, it's not.
Majority.
There is just millions and millions and millions of people work at small companies. All right. Well, that's the House bill on how it affects your retirement accounts. Okay, remember, they're talking about giving you a little more time to pay back loans. They're on a 401k. They're talking about standardizing government 401ks, which is like a 457 plan or so, standardizing that with your 401ks to say you can touch the money at 59 and a half. They're talking about, one more thing. They're talking about auto-enrolling your 401k in an IRA for people that go to work for a company that doesn't have 401k available. Okay? So, and you can't recharacterize a Roth. Okay? That's about it. But those are a couple things. We'll see about 15 different gyrations.
I was going to say we'll be going through the next iteration probably in 3 weeks, and then the one after that in 4 weeks, and then another one in another month. And
since there's 52 senators, first they got to pass the deal that it's not going to have to be 60 votes, right? They already know they're going to throw out Rand Paul.
Yep.
He's never going to vote for anything unless it's 100% of what he wants, right? And so you got one person, and you always got a couple moderate Republicans, like in Northeast states, that always vote no too.
Well, and you got,
So
you
you're gonna
got
have to get all of
McCain,
them.
who's pissed at Trump. You've got the New York folks, Republicans. You got the California Republicans, who legitimately their constituents. It'd be awful hard for them to vote and raise their constituents' taxes by getting rid of the loophole of being able to write off state income tax off the federal. So yeah, there's all sorts of issues, right? I hope they get something through, but it's not an easy road to go.
I was going to go over the 17 unexpected retirement expenses in retirement. The reason I'm going to go over these is when you do a retirement plan, I don't care if you're 45 years old when you're doing a retirement plan. There's never too early. I guess it is when you're 25, maybe.
Yeah, things change too much.
Got to be at least 40, I guess, to do a retirement plan, really. But if you're doing one, they should address all of these issues.
My favorite are the two hardest to address. Are they in the list of 17?
I don't know.
They got to be the two. What's the two hardest? We never know how long we're going to live.
Oh yeah, that's in there.
And it's impossible to forecast medical expenses.
Right. Yeah, you have to, if your retirement plan doesn't address these. Like I said, I just looked at another one this week that said, well, this person said, oh, I'm going to be fine. I don't need anything. I've already done a stress test and they're not going to be fine. And they go, well, why is that? I go, well, they're telling you what you want to hear. He goes, what do you mean by that? They go, all the retirement plans that I've seen coming out of the big firms are an average market scenario. So they basically said, you got this $1 million, you need $70,000 a year. They haven't factored in inflation. Even if they did, sometimes they do. But they've assumed an average market, like making 10% a year for the rest of your life. So think about it. They've completely ignored the sequence of risk returns, sequence of returns risk.
No,
completely ignored it. And what it does, I go, you could have told me that. I could have told you that before you came, and you don't need a financial advisor for that. If you got $1 million and you're making 10% a year, that's $100,000 a year, and your expenses are $70,000 a year.
You're in pretty good shape.
You'll be fine.
Yeah.
They completely ignore the fact the market drops 50% like it has twice in this century, and then wait a minute, I got $1 million. Now I got 500,000, but I got my 70,000 bills still coming out, right? So I got $430,000 on $1 million. So if that thing makes 20% a year, 3 years in a row afterward, because sometimes the rebound's pretty good.
Yeah. Oh yeah.
You're still broke. It can never recover.
And the net result of that is if you started counting from the year 2000, and granted we've had two drops, right, 2000 and 2008, the market has made a compounded rate of a little over 4%, and that's if you had no fees on your account. Now, if you're going to withdraw and have fees on it, you didn't make 4%. So, plain and simple, you didn't make 4%. Can you withdraw 7?
Yeah. Or can you have a retirement plan that's based on 8 or 10?
Yes.
You can't have a retirement plan based on 8 or 10, ignoring the last century,
and that's
the last 17 years. But that's what they do. 95% of them. It's exactly because it's easier to tell you you're going to be fine. Just sign up here. Then, well, you're not going to be fine. You're going to have to make some hard choices. You might have to buy an annuity to get some income, all that kind of stuff. That's hard. It's easy to say, no, just sign here. It's liquid. You're gonna take care of you. By the time you go broke, they'll be retired and they won't care.
What's the worst thing to tell a client when you're in a meeting and you're doing a stress test? You got to reduce your expenses.
Oh yeah,
they love that.
Oh, yeah.
No.
I mean, we're gonna tell you the truth. We're gonna tell you the truth based on a stress test. What if things don't go great? Are you eating cat food when you're 80? That is what we do here. All right, we don't, and we're gonna account for all of these unexpected expenses in retirement that the other firms don't. So instead of giving you a pie-in-the-sky deal that you average 10%, which means nothing, because it just takes one down year to wreck that entire retirement plan forever, the retirement plan we put is more bulletproof. If you do that 50% down, you're still fine.
The downside for us is we'll show you a stress test and realistic numbers what you have to do. The downside is when you go to somebody else, they'll show you bigger numbers, 9%, etc. And it's real difficult to reverse. That's an irreversible decision. Once you go down that path and you're withdrawing and your balances are down.
Also, the market's done so well the last 9 years. It hadn't gone down in 9 years. The longest bull market in history. People's memories are short. They think it's fine. What am I going to do? It's going to be fine. It's not going to be fine if you're taking distributions in retirement. And that's what you have to do. You have to take your stuff and actually do a stress test with it. You can actually, when you put a stress test, you can put some returns in there if you're being reasonable. But it'll show you the real world result of what happens, rising healthcare costs, rising housing costs, all these different things. It'll show you that. Instead of some pie in the sky deal, you hear what you want to hear. You don't have to change your lifestyle. You're getting plenty.
That's exactly what you.
Oh,
What's
I hear
better
that.
than asking a question and getting the answer you want? How often
That's
do your
right.
kids come to you,
That's
go
right.
to their mom, and they keep asking the question until they get the answer they want?
Well, I was listening to Ken Fisher's commercial the other day,
Yeah.
and he said annuities are the devil's work, basically, and anything you can do, you can do better. Okay, my first response would be, all right, take out 7 to 10% of the money a year and have it not run out. That would be the first one. Take out 6% and not run out.
Yep.
His own material says you can't take out more than 3.
That's right.
So that's right. You don't. If you've got $1 million and you can live on 30 grand a year, your options are more open.
But apparently, when you're in politics or you're selling something, you don't have to tell the
That's
truth.
right. Remember, you're going to have people that sell things that are selling competing products that the annuity people do it too. They're saying the stock market's a Wall Street casino, and why would you risk? That's BS.
Yeah.
Just like it's BS that the annuity that's been around 2,000 years is the worst thing you've ever seen.
Devil's Workshop.
Yeah.
Something's crazy. That's
I
right.
go, what you've got is for every one of those, I'll have a Nobel Prize winner that'll tell you it's a good idea. So every one of your Ken Fishers out there, I'll tell you a Nobel Prize winner that says it's a good idea. Remember, the Nobel Prize winner in economics has no skin in the game. They don't care. Actually, 2 out of the 3 that I'm referring to are actually at stock firms. So they're a Nobel Prize winner in economics, and they're a professor, and they're part of a board of a stock firm. Why would they say annuities are a good idea for most people?
Right now, people in annuities, at least for us, are happy and they're comfortable. People that we have in stocks are ecstatic.
Right.
The problem is when it reverses, and it will, it's just a matter of when, the annuity people will be ecstatic and the stock people will be pissed. The annuity people are kind of middle of the road. They never get pissed, and that's kind of where you need to be.
Don't hesitate.
I don't like being pissed.
Don't hesitate to call us. We'd be more than happy to prepare a plan for you. It's 972-715-2424. Again, 972-715-2424. Let's talk quickly about the 17 unexpected expenses in retirement. Loss of capacity.
That doesn't sound good.
That's number 17.
I don't like that one.
In other words, you have to have somebody else manage your money
No,
because you've lost it, right?
Yeah.
That's one of them. That's a lower percentage. For somebody 70, it's only a couple in their 70s, might be a couple percent. It's going to go from low to high here, right? Divorce during retirement. This is something a lot of people do not plan for.
I see that. You wonder after 20, 30, 40 years, all of a sudden you wake up and say, I want to be single? How does that work?
I'm happily married, but I get it sometimes. But so divorce in retirement can change because you got to split everything up, but your bills usually aren't half.
No, you're right. They'll go down, but they won't go down in half.
That's right. So that's one you have to. A significant damage or loss to your home due to fire or natural disaster. That's still on the low end, like 3%.
Unless, and hopefully it's covered.
Right. Loss of home through foreclosure. That's another small one, like 4%. Bankruptcy in retirement.
There was no stress test there if you lost your house through foreclosure.
That's right. Bankruptcy. If you go bankrupt, what happens, right? Victim of fraud or a scam. That's about 5% of people in their 70s. 5% of people in their 60s, by the way.
A lot of widows.
11% of the people in their 45 to 60. So
Wow.
the younger ones are getting scammed more than the older ones. Loss in value of your retirement savings of 10% or more because of poor investment decisions. All right, these are the 17 unexpected expenses in retirement. And that one is a little higher. That's like, well, think about this. Who loses more? 45 to 69 loses. Or 45 to 59, 16% of them.
They're probably still too aggressive,
right.
Yes?
Yep. 8 or 9% when they're older.
Yep.
Death of a spouse is another thing you have to plan for during retirement. What if your spouse dies? Also, what if your spouse goes to a nursing home? What happens is both of you don't go to a nursing home at once, typically. One does. The other one still has the same bills coming out, but now they got an extra 5 or 6, 7 grand a month coming out.
Yep.
You have to plan for those kind of things.
Which is like buying a $600,000 house. Think about it.
Yeah.
On top of what you have.
Right. And so even though long-term care insurance and all that is not cheap, a lot of people should look at it. Now, there's other ways to get it through life insurance, annuities policies,
Some
stuff
annuities
like
will
that.
do that, yeah.
And you want to look at those too, but you cannot ignore the fact that one of you could get incapacitated. All right, the next one. A family emergency that makes you to spend 10% or more of your savings on it. I have 4 children. Trust me, things happen.
And 3 more part-time children.
Oh, yeah. So this happens to a higher percentage. 20% of people 45 to 59. When you're 70 to 80, it's 11%. So it's in the 60s, it's 11% of the time. That happens a lot where you have to come out. Going on Medicaid, retirees, now this is 14 to 24%. We're getting higher numbers now, more likelihood.
You go on Medicaid, you don't have much left.
Well, I mean, you go on Medicaid, they've drained you pretty good. And they look back 5 years to make sure you didn't try to move money around to relatives.
Yep.
All right. Now, here's another one. Sudden loss of total value of savings of 25% or more in the fall in the stock market. That's a good one. 70 to 80 happens 20% of the time. 20% of the time you lose your retirement savings there. All right. Running out of assets.
Apparently not if you're with Ken Fisher. Psych.
You run out of assets completely. 45 to 59, 23% of the time. 70 to 80, 13% of the time. To me, that is the number one thing you have to protect against. A lot of things you can't, it's hard to protect. If you just don't have enough money to buy long-term care insurance, it's hard to protect. But running out of money is something you can protect.
And like life insurance. Oh, well, unlike life insurance, you need long-term care when you get older. As you get older,
right.
You may not need life insurance. But the similarity is, as you get older, both are unaffordable if you wait to that point to get them.
They say everybody wouldn't think about not having insurance on their home. Yeah, it's like a 1 in 1,000 shot your home burns down, right? It's like a 1 in 2 shot
50%.
that you got to have long-term care coming in. So you got to consider, and we do that. We do long-term care insurance. We do your homeowner's insurance. We do health insurance, all that kind of stuff. Call us and we'd be more than happy to look at that for you. Illness or disability that limits the retiree's ability to care for himself or herself. That's what we just talked about. That's 14% of the time that happens. All right. Drop in home value of 25% or more. That happens 20% of the time. It's weird. Real estate people are the most optimistic people in the world because it goes down. It goes up. They're the smartest thing in the world. Look at me. I did all these different things. Then it goes down. It'll come back right away tomorrow.
Man, if the house is paid for,
doesn't matter. That's right.
The only time we're going to sell the house is when we need to move into assisted living.
And I think that's people didn't plan properly. Remember, our plans are going to say, "What if your house drops?" Okay, does that mean something's wrong? All of those things have to be accounted for in your retirement plan. All right, here's a big one. This happens like 20 to 30% of the time. Significant out-of-the-pocket medical or prescription expenses from a chronic health condition.
Hard to forecast.
Or a disability. That's one you have to, potential rising medical costs you have to cover. Major dental expenses, believe it or not, happens like 20 to 30% of the time for retirees and pre-retirees.
Well, you're not doing dentures, which weren't cheap. Now everyone wants implants. So it's like a $50,000 deal, right?
I think it was $50,000 10, 15 years ago. I think it's like $4,000 a tooth now.
That's crazy, man.
All right. What's the other? Major home repairs and upgrades. You know how many retirees I know in their 70s that are redoing their kitchen for $30,000.
There's why they get divorced late in life. The wife wants to do all these upgrades. Honey, we can't afford it.
Well, you watch those DIY channels. They do a whole kitchen for like $2,000.
I
put hardwood floors in this entire thing. Oop, that was a big expense. $2,800. I'm like, you can't do a room for $2,800. What are they talking about? A whole house? It always kills me when I know I redid my hardwoods in my house, and they said, "Oh, it's nothing." How much time we got left? Okay, wrap it. I want to thank everybody.
The engineer's holding up a sign. Wrap it up.
I want to thank everybody for listening to the Common Sense Investing Show. Remember, call us if you have any financial questions. 972-715-2424. Again, 972-715-2424. Or you can go to our website, ilovemyretirement.com. I'm Victor McClure. For Guy Allert, we always appreciate your time.
See ya.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment, product, or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.